Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Marathon Oil. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today's stock is MRO, Marathon Oil. But before we get to the stock play of the day, let's look at what's going on in the market. So right now I have a chart of the S&P 500 index. The only good thing that I can say about the chart is that we still have our ducks in a row. We still have the 200-day moving average below the 50-day, below the 20-day. But the 50-day is usually worked as a good line in the sand, and it did not hold up the marketplace this time around. We actually had a solid breakdown below the 50-day moving average, and that kind of brings the 200-day into play. So the markets are just a little bit choppy right now. We have the VIX index up above the 20% level, showing a little bit more angst in the marketplace, a little bit more volatility just in general overall. But that's not the big news. If I go back to our VIX watch list that we have, we'll highlight right now that the S&P 500 index is down about 1.5%. The NASDAQ is also down a little bit more than that. And the NASDAQ chart doesn't look quite as good as the large caps, as the SPX overall. But the real story is the 10-year. So the 10-year is at a 2-year high as of today, as far as the yield is concerned. The index that I'm showing you here is the TNX, which shows you the interest rate on the 10-year bond. 18.14 means that we're at about 1.84% on that yield. And you see here on the chart, we're not quite up. We had an area, a high back in April. We've broken through that pretty good so far. And the next stopping point is right up here, maybe right around the 1950 level overall. That would kind of be where the yield would be looking to go if we continue on this upward trajectory. People are nervous about it, but overall, rising yields in this marketplace doesn't necessarily mean bad news. It means that the economy is rocking and rolling. And usually when you get rising interest rates, the markets overall perform better than normal. Where you have issues is where you have a 2% interest rate and you start going backwards on the yield. In other words, you're worried about the speed of the economy slowing down too much, so we're going to lower rates. So in general, you just say, stay the course. As far as the market is concerned, we got a little bit more volatility because we're reacting to what the Fed is looking to do going into the new year. And with the yields at an all-time high in the first over the last 2 years, we haven't seen yields at this rate on the 10-year. And because of that, we just got a down day today. It's just that simple. It happens sometimes, especially if you have a little bit of growing pains. But overall, seeing interest rates right around 2% or going towards that level isn't necessarily a bad thing for the economy and the markets overall. All right. So with that said, what sectors like increased interest rates? Well, the best sector so far this year, or I should say going into the end of last year and the beginning of this year, has been the financials. We have a lot of companies announcing earnings. As a matter of fact, Charles Schwab, one of the bigger financial companies, did announce. They were pretty much as expected across the board, but the stock is selling off. Stock overall is up about 7% on the year, and that's considering that they're down about 5% today. So we're going to see a lot more financial companies announcing earnings this week. And I think a lot of the sell-off just has to do that they've been doing so well that investors are looking for a reason to take some gains overall. And earnings is usually a time when people consider that. So MRO is going to be our stock today. It is an energy company, an oil company. They also deal with refinery And the stock is trading right around 10 times earnings. So we see some value. Last week we looked at a value play in Micron Technology. This week we're kind of searching for value also, and something that likes an increase in interest rates, like most stocks that deal in commodities do. So we're just going to do a simple trade, straightforward. We're going to look, and we kind of build these as FOMO trades before. As a matter of fact, going back 6 or 7 months, we looked at a out of or deep in the money call option in the financials, the XLF. And so we're going to kind of take that same approach here, but we're not going to look at an ETF that tracks the energy companies. We're just going to pick MRO. MRO trades around 10 times earnings. Look to see a little bit of value there. We've just set a new high in MRO recently. So let's get into the trade for today. And before I get too far, though, I also want to tell you that please put your questions in the chat box on the right hand side. I'll try to address any and all questions that I can today. So I would love if you would participate in our stock play of the day. We like to make this as interactive as possible. So let me get up the chart on MRO. 1 second here. Let me get the symbol in. So Marathon Oil. So if we look at the chart overall, we have a fairly strong line. Nice, real strong move recently. Kind of goes in tandem with the increase in interest rates. We have the ducks in a row. All of a sudden, we have the 200-day, then the 50-day, and then the 20-day. This would be considered a golden cross when the 20-day crosses over the 50-day moving average. But we just, in general, have had a real strong market. And if we just zoom back in time, you can see that it's been a fairly solid move in MRO going all the way back to November. Now, my only concerns is that it has gone basically straight up. Got a little bit of a down day today overall, maybe a buying opportunity. But this is since December, or basically since the first of the year, we've had a strong move to the upside. So by using options, we can participate. And this is where the FOMO comes in, the fear of missing out. Yeah, maybe we're a little late to the game. We've already had a good move up on the underlying stock, but how can we participate and limit our risk overall? And that's the most simplest trade that I have inside the options playbook. If you go to optionsplaybook.com or you have the actual book, you want to go to the rookies corner. And we're going to look at buying a leaps call as a stock substitute. Now, this outlines the strategy in detail, and I do think that this is a great place for beginning option traders to consider. You want to have fairly liquid markets. MRO does have, and that's usually an issue when you're buying deeper in the money, longer dated options, is you want the width between the bid-ask spread to be reasonable. It's not going to be as liquid as the underlying stock, but as long as we have some volatility, some open interest in it, maybe we might want to consider doing this and limiting our risk, but also getting something that kind of acts like a stock. Another way to say it is you're looking at a surrogate for the stock. Now, in the title here, it says LEAPS, and that's just a fancy marketing acronym that the Chicago Board Option Exchange put together. It just means long-term equity anticipation securities. And it's just longer dated options. They didn't need to give a special name for these option contracts. It just means usually a leap would be considered that you go out over 9 months in time. In our trade today, we're not going to go out quite that far. So let me get over to the actual option chains. We'll take a peek. We're down 14 cents right now, almost 1%. We do have the earnings date coming out in February, so you want to be aware of that. February 16th is when it would be anticipated. There's going to be a lot of companies that are going to be announcing earnings over the next couple of weeks. And if we scroll down, I'm going to go out to the July 15th expiration. We're going to go out 178 days. The stock's trading at 1930. Now, the concept of the FOMO trade is that you're going to buy something that acts like the stock. You're going to buy a surrogate for the stock. If you were considering buying 100 shares of MRO as your trade, then you would look at buying one call option. If you were thinking about buying 200 shares, the FOMO trade would be to buy two call options. So you're not over leveraging your account. You're trying to use options, what they were really first intended to do. We're going to try to manage our risk, but have some type of position in this trade. So I'm always trying to target a delta right around 80. In this instance, the 16 strike with that expiration, and we're looking at the call side of the chains here on the Ally Invest platform, and see it's trading 440 by 455, and so you got a 15-cent wide bid ask spread. That's, that is a fairly decent, well, that with this, obviously a lot wider than if we bought the stock outright. The width between the bid ask spread on the stock is going to be a penny wide. On the option contract going out further in time, it's going to be 15 cents wide. And honestly, if we had extremely tight markets on in the money option contracts, I think the strategy, I don't, almost everybody would be doing this strategy, especially if you weren't planning on holding MRO for the next 10 years. This is a great way to get your feet wet by dipping your toe in the water, giving you something that acts like the stock, but doesn't have all the risk of the stock. Problem is, right now, it looks like we'd be paying about a 10-cent bid ask spread. This means that if we were buying the option contract, we would pay 450 for it. If we're turned around and sold it right away, we would receive 440. Hence, if we are a retail customer placing this trade, we would be down 10 cents on that trade almost instantly, right? Okay, so you can work it a little bit. We got a little bit of volume, a little bit of open interest. The more open interest, the more volume, obviously, usually leads to a tighter marketplace overall. But we're going to make this the official paper trade. It's going to be very straightforward here. The midpoint is 445, but a lot of times when you're placing this trade, it is hard to fill at the midpoint when it's a single leg option contract. So I want to keep that in mind. I'm going to put it in the right rail, and it will become the official paper trade for today. And I would probably work this. I just saw that the market just moved. We just saw it at 450. I think that's what I would try to pay for it. Always I'm entering limit orders when I'm trading options. Very, very rarely would I enter a market order. I'd have to be in a very, very liquid underlying, like maybe the SPY, which is the ETF that tracks the S&P 500 index. Something that's extremely liquid, I may consider a market order. But in general, if I'm placing a trade on options, I'm always going to put some type of limit on it, limiting the price that I'm willing to pay. So we're buying to open, the July 15th expiration, 16 strike call option. We're going to limit our order to a net debit of $4.50 to the account. That's $450 plus commission. Guess what? That's going to be our total risk of this trade. Now, if you take 450 and divide it by 1937, you're talking about a 25%. You're paying about 25% of the stock price. You're getting about 80 cents on the delta. So if the stock goes up one, well, to be more exact, I should probably say 77. Means that if the stock goes up one, we would expect this option contract to increase about 77 cents for every 1 point movement on the underlying stock. So on the stock, if you own the stock and the stock goes up one, and you have 100 shares, you're going to make $100. This concept would be that if I'm buying this option contract, the delta is implying that if the stock goes up one, I should make around $77. Now, this is in theory. This just gives you a realistic expectation, but it's not guaranteed that it's going to move that. But in general, delta is a dynamic number. And as the underlying stock goes up, you usually gain delta. It acts more and more like the stock. And that's what makes this trade so interesting. If I run down and I look at the profit and loss graph here, and I do see a couple of chats in the chat box. Please put your questions in. I got a couple of them. I'll get to them at the end of the show. We're almost done with this, with the play of the day today. So if I go and I look at, I'm going to zoom in on the Ally Invest profit and loss calculator. Here's where the underlying stock is. That's the gray line. We are buying an in-the-money option contract on the call side. That means that we are below the underlying stock price. As of today, we're going out all the way up to July 15th, so we have a lot of time on this. The colored line is showing you the profit and loss based off of today's market conditions and what we're willing to pay for it. The dotted line shows us at expiration. So here's what I'm going to highlight when I was saying, I'm going to say it in a different way. As the stock goes up, you increase delta, but as it goes down, you decrease delta. So you have the acceleration on the upside where you pick up more delta, and then you have the deceleration on the downside. And what does that do for us? That means that if we're correct on our forecast, you'll notice that as we go higher and higher and higher, we get more and more of the stock price move. It starts acting more and more like it's right at expiration, moving one for one with the underlying stock. But on the way down, we have that deceleration in delta. Delta gets smaller and smaller, and it moves as we lose more because we're incorrect on our forecast. The option contracts moves slower to the downside. So whenever I'm looking at a FOMO trade like this, now we kind of build this as it's obviously a more of a longer term trade in marathon oil. We are a little bit more longer term bullish because of mainly because of interest rates overall, and energy stocks didn't do very well during the pandemic. So now we're kind of seeing some rays of sunshine overall. But as it goes down, if we get to the $16 level right here, which is our strike price, this is where you really see the most dichotomy between the dotted line and the colored line, that as of today, the forecasted price on the underlying stock. And that's mainly because right at the money is where all the time premium gets held, right? That's what people are willing to pay for, are those at the money option contracts. And it kind of gives you a buffer. So if I'm doing this trade and the stock does come down to the 16 level, down to my strike, I want to consider getting out at that point in time. Now, obviously, this helps if you're wrong, it'd be better to be wrong sooner than later because you have the time premium helping you out. If we cut this in half, let's go all the way down to 90 days. Right now we're at 177 days left to expiration. You're going to actually, I'm going to go, let's go all the way down to like 30 days. And so I want to make it dramatic. And you'll see this line drop closer and closer to the dotted line because of the time decay situation. So we'll go all the way down to 30 days. And now you see it starting to act a lot like the underlying stock right at expiration. But we still do have that small pillow to land on. So even if it takes that long for us to be wrong about our forecast, it still gives you a buffer. It still gives you a little bit of a buffer. So, like I said, this is an interesting way. We have a stock that's been hot. It's made a good run up. We're coming into earnings season here. How could we participate? Remove some of the risk of owning the stock outright, but still have our toe in the water, if you will, so we can participate on any further upside moves with limited and known risk. And that play is buying a deep in the money, longer term option contract as a substitute for the actual stock. All right, so I'll scroll back up here. We'll go back to the top of the chain. Going to highlight earnings because that's important. Like I said, we won't be able to talk about many stocks in the near future that don't have earnings date in front of them here. But I do see a lot of questions in the chat box, which is great to see. Okay, so to start with, first question from Zshan. When will we be stable again? Well, I kind of think we are a little bit stable. One of the things, like Zshan, that we're talked about is one of the things that's nice about the S&P 500, and I'm not going to run to the chart right now, but we still have a bull market. We still have the 200-day below the 50-day, below the 20-day. So we're still doing okay in the marketplaces overall. Some of the sectors, like I highlighted at the beginning of the show, financials, energies, companies that don't mind an increase in interest rates. I think what would add to the unstableness of the marketplace is if the Fed were to react quicker than anticipated than what the marketplace thinks they should do. And that would be my biggest concern. If they're slow, if they're forecasting that they are going to go higher with their interest rates, what they are doing right now, and they keep communication with the marketplace overall, let them know what's coming, and they're not doing anything to shake the markets or surprise the marketplace overall. I think that the markets will still stay fairly stable. We're still near all-time highs. We've just had a little bit of a trouble in the tech sector, and the Russell 2000 has been basically flat for a long time overall. We would really like to see the small cap stocks start to join in on the upward movement also and set a new high. So that would be a good thing for the market. I'd love to see the Russell at a new high over the next 4 or 5 months. That would be great. All right. Bear call spread or bear put spread, which is better? Please, what I understand that bear call is more risky. No, it's all about how you set up that trade. So I'm going to run to the options playbook. And the question is about just two strategies, a little bit off topic, but you have two different option strategies. You have a bear call spread and a bear put spread. These are under the veterans trade. No, they're under the seasoned veterans. Short call and short put. Okay, so here's a short call spread and here's a short put spread. The thing about these spreads is you have limited and known risk. You see here from strike A and below on the short put spread, your risk is limited. You go to the short call spread, and it'll be from strike B and above, your risk is limited. So there's not necessarily a riskier trade overall because you're defining your risk by the strike prices that you are picking. If the difference between strike A and strike B is 5 points, well, that's your maximum risk. If you decide to go 10 points, well, then you're adding to your risk, right? So it's all about the strike prices that you choose to determine the risk. Now, there's not necessarily, your forecast and the underlying stock that you're trading also will contribute to that. But with that said, you determine the risk overall. So I would not say that either a short call spread or a short put spread, that either one is more risky than the other. All right. What would you expect to happen in the market should Russia invade Ukraine? How about oil? Well, I don't necessarily have an opinion on what that may or may not do to prices, but it is a good point, Clinton, and it's something to think about overall. But if you think that an invasion like that may reduce the amount of oil on the marketplace, well, overall, that should be good for oil prices. You would think that having less supply out there and with solid demand means that we're going to have higher oil prices overall. But I think it's more of an interest rate play. The fact that I mean, going into the end of the year, I see interest rates going higher. I mean, obviously that 2% level, we just broke out of a new high, getting up to that 2% level. You're obviously going to run into some resistance at that point in time. I'm not quite sure if we ever get there by the year end and the 10-year, but this is more the thought of why we're buying MRO today. All right, next one. William, if I wanted to enter a spread on this trade, what would you suggest? If you wanted to do a spread, are we going to do a bull call spread? In other words, we're going to look at a trade like we did last week in MU in Micron Technology. Yeah, if you're doing it, I would set it up a lot like the MU trade overall, William. If you do think maybe you want to get out of the trade before earnings, look at a bull call spread. I would pick something before that earnings date because I don't necessarily want that risk of that earnings overall. Maybe looking at I'm pulling these up. So February 11th, that's 24. I'd maybe go at 17 days. I'd go at 17 days and I'd straddle the market. I would look at buying the 17 strike call, selling the 21 strike call. 4 points wide, should get it done for about $2. If you're straddling the market and it's 4 points wide, you should have just as much risk as reward. And that's the way that I would approach it. A little bit shorter term. Go back if you want some more explanation on that. Check out last week's video in Micron. All right. They're rolling in. Some great questions so far. Let me see how many more we got here. So Wayne is back in the chat box. Nice to see you, Wayne. Happy 2022. Can I sell a shorter dated option against this? What expiration and deltas would you suggest? I would, but I would avoid earnings, Wayne. If I'm going to make this a fig leaf, which is inside the options playbook, which means it's basically an alternative to a covered call if we own the stock outright, but I'll highlight the fig leaf here. I don't mind doing it, but I guess I could sell one that's going to expire before earnings, and I would consider that. I don't want to be in this position around earnings because you don't want the stock to get called away from you, and mainly because you don't own the stock. You own something that looks like the stock. So I would probably go to that same expiration that we just highlighted. Let me jump back. Looks like the February 4th, about 17 days out. But I don't know how much premium we're really getting if we go that short. So let's look at where that's at. Yeah, we're doing pretty good. I guess we could sell the 21. We're paying $4 some for the option. You could get 33 cents. That's not bad. And this is actually these shorter term options in MRO that got really good markets. It's a not a bad vehicle to actually trade options in. Relative to a lot of the other energy companies, I should say. Decent bid ask spreads overall. Okay. Sambit. Looks like IV is pretty high at 50%. Can we make a leap call spread to take advantage of it? Yep, we talked about that, Sambit. And I wouldn't do a call spread. I wouldn't do the same expiration. I would do more like Wayne is saying, look at the fig leaf selling a shorter term option against it. Also, if you're going to do that, I do have a section inside the options playbook called managing your positions and rolling a covered call. This is how to try to avoid assignment if the stock price is reaching your short call strike. These are some of the procedures and things you want to think about if that happens, because you want to avoid being assigned on this overall. So I don't mind the leap call spread. I don't mind selling some of this premium. Once again, I don't want the risk of being in a short option around earnings. So I want it to expire before that. Looks like because of what you mentioned, Sambit, the I volatility being pretty high, that wasn't a bad scenario when we looked at this 17-day 21 strike call. As a matter of fact, you might even go up to the 2150 and bring in 20 some cents as opposed to 30. I mean, I would consider that because I'm getting something for the 2150. That's a decent amount when you consider you're only paying $4.50 some cents for that option contract. All right. So NG says, could you explain what a full-time option trader's portfolio would look like? Is something like 80% of the account value is cash and the rest are option positions? NG. Okay, so if I'm a full-time option trader, what amount of cash would I have in my account? Yes, I would have more cash than I would if I was trading stocks outright, an entire portfolio. Like last year, you would have wanted to be 100% in the market in hindsight, right? And have all your cash working for you. If you're looking at options, I don't mind this scenario. Let's just say that our portfolio is made up of these trades that I'll call FOMO trades, where I've had a good run up. Maybe I own some financials in that. In this instance, we're paying 25% of the stock price. So that means that we're going to keep 75% in cash. And if you set up your portfolio like that, and that was your trade, well, yeah, you would keep a lot of that cash on the sidelines. Now, I personally, if I was thinking about buying 100 shares of MRO, I would probably buy 2 call options. That's the way that I would approach it. I look at it as this is how I want some of that upside by buying this option contract, but I want to get a little bit of the leverage factor. So a lot of times when I'm looking at FOMO trades on companies like MRO in this scenario, and that's what this show is all about, by the way. We're just trying to, nothing's meant to be a recommendation. We're just trying to apply plays from the playbook that fit the market conditions, right? There's no 100%, this is always the best strategy to use. You want to look at the marketplace and what's going on and what you want to happen in the underlying stock, and then apply the option strategy to it. So, I brought up XLF. That was a trade that made sense back then, and that one happened to pan out overall, where we went deeper in the money, managed our risk, but we still got some good upside, and the financial stocks have done well ever since then. And then we've had a few that haven't, where you look at it and you're happy that you're in the trade because you manage your risk on the downside. I hope that helps. That's a tough question because you got to know, what type of trader are you? Are you a iron condor trader where you have a high potential of profitability, but if it goes against you, it goes against you hard? In that scenario, I would keep less in cash because most of the trades we're going to do okay on, and we need that cash to be able to generate enough income. But if we're talking about just this strategy today, yeah, you could 25%. That's what we're putting up for the stock, as opposed to buying 100 shares outright. So that means you have 75% in cash. All right. How do you find the IV? Well, on our change, the IV is right here. That's simple. That's simple. Most option chains would have IV. So in this instance, I think someone mentioned it. Yeah, Sambit mentioned that the IV is around 50. This is what Sambit was looking at right here. All right. Uh, all right. All right. Well, I think we answered all the questions. Well, that's it. What a great stock play of the day. Thank you for coming in 2022. We're going to continue to give you great content. I'll be back this Friday, and well, maybe we'll look at selling a call this Friday just as something in the stock play of the day overtime. And please click subscribe, ring the bell, and we'll see you this Friday. Thanks for coming, everyone.